Good Wednesday morning, Market Chameleons, and anyone else joining us from the outside world. Here comes Dimitri Pargamonic, the King Chameleon. How you doing, Dima?
Hey, Will, how's it going?
Great. I have a disclaimer out there. You want to get right to that before we get started?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
All right. So what are you seeing this morning, my friend?
So as I was just getting ready for the, for today's show, and, I was looking through earnings, but I think that there's another discussion maybe just worth mentioning. It was on my mind, and it's kind of cost of carry, because I think a lot of times, especially people just initially getting into trading and finance, think of things as in a world of things go up or down, right? It's either going to go up or down. And as a trader, that is a very simplistic approach, and you analyze things from many different angles, like spreads and relative values and price versus valuation. That plays a big deal. And another thing that is important is cost of carry. Okay, and I'm going to show maybe two examples of that. I was going to do earnings, but it was on my mind already, and sometimes I like to find examples of maybe something more extreme or something, that's easier to see. So I'll show two examples. I think it's worth talking about. It's worth mentioning. I think it's going to help people in the longer term to think of things differently, not just in terms of, is this thing going to go up or down? Okay. So we'll start with that. We'll go over the pre-market. We'll see what's moving in pre-market hours. And then what I'll do is I'm going to use an example of two stocks that are been in the news. One is the Bitcoin ETF, right? So that's just recent. They have options out there. And then Robinhood just reported earnings, and, it's in the news, but not so much of about the assets themselves, but how the markets are lining up. That's what we're going to take a look at. Like, how are these markets lining up? What can I, what insights can I get through these markets? How's that sound?
Perfect.
All right. So let's start first. We'll start out with the pre-market reports. These are stocks that are trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to come down here, and I see that 68 stocks made our percentage gainers list, 78 stocks on a percentage decliners list. Mixed bag, maybe a little bit more leaning more towards the bear side at the open. Let's take a look at the S&P 500 stocks. If we see a similar situation, so I'm going to use this filter in here in ETF. Let's look at SPY. So these are going to filter S&P 500 stocks, and that's 8 stocks made our percentage gainers list, 8 on the percentage decliners list. So even Steven there, mixed bag, so kind of neutral at the open. Let me come back here, and really, I saw Robinhood is in the news. They're down 8%. They reported earnings, and then I was kind of just scrolling through. I saw this Bitcoin ETF. What is it? BITO? I think it's somewhere in here. But I'll take a look at that. And we had an outstanding question. Here it is, BITO, down 5%. So we had an outstanding question in BITO. It was really around, when are the options going to get listed? How are the options look? And, we talked about that the BITO, it's an ETF that invests in Bitcoin futures, right? So these are Bitcoin futures, and the outstanding question is, well, what if it's in a contango, right? So that I remember that, and we're going to take a look at that, so it's a little bit more clear to us what that means. And I'm going to take a look at Robinhood and show you guys how that options, what they're implying as far as cost of carry. So for a while I've been watching it, and what's happening there, it's the reverse of it. Bitcoin, there's a cost of carry going the other way, where a lot of people wanted to be short this stock, and they're paying a big premium to be short. Okay, and you'll see what I mean by that. So let's start out with Bitcoin, BITO. So this is BITO. We talked about just right recently IPO'd Pro Shares, and what they do is, let's just go to their website just to do a recap here. And here you could see that, you know, it doesn't invest directly into Bitcoin, right? It does a futures role. It invests in the futures, and the futures expire. So what happens is, if you buy a future, and as you get closer to that expiration, it settles, you have to go out and roll it back and buy another future, right? So it's a continuous roll, because it's not a perpetual future. It's kind of like a future that just it's a roll. Now I think there are perpetual futures out there in the like cryptocurrency world, but this is not what's happening here. So it's similar to what the VIX is doing, right? So it's kind of like they just continuously roll this future back out as it expires. And you could see here that they're even giving us an indication that this is not going to necessarily reflect the returns of the spot price. And let's take a look at and we could see here that here's the NAV, closing NAV, net asset value of the ETF, $40.04. Marketplace is $40.06. So it's like right there, trading where the net asset value is. You know, and here they tell you how the futures are rolled. So let's just take a look at that futures. What are you buying through this ETF, right? And we're going to just kind of figure out, you know, and there's going to be a negative drag on this. Now, of course, if Bitcoin goes up, futures go up, they'll be good, but there is a negative drag on this ETF. And I am noticing here there's about almost a 1% annual fee on top of that, right? So I'm going to go here. Here's the Bitcoin futures. This is on the CME. So we see here, this is where Bitcoin spot price is, 58,935, right? So that's where the spot price is for Bitcoin. And here are the futures, you know, futures, October, November, December, you know, so this is the future. So let's say they're rolling into this November, 62,580, right? So that's where you're buying that future. That's the 62,580. You could see that's a significant premium to the spot price, right? And sometimes they'll trade, you know, that above, because, you know, buying spot price, you know, there's interest involved, whatever, but this is a pretty significant premium, you know, with 0% interest rates here. So what happens is you buy that future, and this is what the contango is as you're going out further in time. This is increasing, right? So the spot price is way below these future prices, right? And as you buy the futures, as you get closer and closer to expiration, as we get closer to this date, the futures price converges to the spot price, right? Because at expiration, there you settle at the spot price and you're done, right? So you could see that if all else just stays exactly this, you know, if we do not move from here, right? If we do not move from here and we just sit here, then there's going to be a negative drag on that ETF. Because if the ETF is buying it at 62,580, then at expiration, they get 59,000, right? Then that means they got less money than they put in, and then they got to take that money and roll back out to a new future. Does everybody see that negative drag? Let me know if you have any questions. So
yeah, no, we see it. Jake is saying, why don't we just buy the future directly?
So you can buy the futures directly too, but then what happens is you don't have to pay that 1% fee. But again, if you're buying the future, you're doing the same thing, is that you're paying a much higher premium than the spot price. And we talked about that, the benefit you get is that you don't put up all the money, right? So if
why, I guess my question is, why don't you just buy the Bitcoin contract?
If that's what you want, right?
Yeah.
So the future would be, it's a derivative. So what you're doing is you're paying a premium, so you don't have to shell out, the $59,000. So you're leveraged. You're only putting up whatever margin that your broker tells you to put up. So you are leveraged, but for that you're paying a premium, and there's a pretty big premium here, right? So
and the way they structured the BITO, obviously you get in the dollar figure is much more manageable for most people, and you don't have to open another account, right?
And you don't manage it, right? So you're not looking at, you're not worried about the margin and all that and rolling it. So, but the idea is that and the bigger the contango, the harder it is to make, the higher premium you're paying here, the more difficult it will be, because now you need it to rally above that price, right? Or you need it to rally, but you need people to pay higher than that price. So, this is an important thing, because what we're talking about here is a cost of carry, right? There's a difference between the spot price and the futures price. And some people, there's arbiters, right? Arbitrators who will say, hey, this spread is large enough for me that I'm willing to, buy the spot price, sell the future, and wait for it to converge, right? And wait for these to converge. So here, March 2022, you sell the future almost 65 grand, right? You buy this for 59,000. So you got, I don't know, like say $6,000, 10%, whatever, that once they converge, right? That it doesn't matter, it goes up or down, they're going to converge to one price at expiration. And there you have your arbitrage, right? So two ways of thinking, right? Some people just want to get long it because they want to leverage bet. Other people might think of a different way, but with the cost of carry there, and the difference in this between spot and future is enough for them to carry that and earn the difference. So what we did was we looked at a contango where we're actually this spot price, right, that you're buying, that this ETF that you're buying in the futures is above the spot price, right? So now you got to deal with that, because now it's a little bit harder. Not only does the spot price have to go up, it has to go up to cover that premium. And they did list options in there, right? So you have options now in there. And again, I think there's a negative drag to it. So if I was looking to potentially, get short, if I thought that, hey, I think Bitcoin's going down, then doing it this way, it's like extra edge, right? It's a little bit extra edge because now I got a little bit of cushion there, right? So think of it this way. Hey, I think Bitcoin's going down from now till February. It's going to be below 59,000, right? If it's below 59, I'm convinced of that. And you could sell it, 62, what did I say, November? 62,580. Well, you got like an extra cushion there, right? Because as we get closer and closer and closer to expiration, it'll get closer and closer to that spot price. Hopefully people see that, okay? So again, I'm not saying it will go down, I'm just saying that now you're looking at your options and cost of carry and how you're getting a little bit of extra there. It's like a little bit of edge if you're thinking of the downside play. Everybody good with that?
Yeah, everyone's good, D.
Okay. So let's take a look at now the opposite side. And this is I'm gonna look at Robinhood. Okay, so this is Robinhood. And they've reported earnings today. They're down 10%. And I was looking, here's the cost of carry. Let's go out to like, I don't know, maybe November or even like December. So here's in December, 37 trading days out. And you see here where, now this is all lighting up green, these theos, these are red. It means there's an issue at the cost of carry. Okay, so according to the Black-Scholes model, there shouldn't be, the Black-Scholes model always assumes that you could borrow and lend at the same rate. Remember, we're talking about a model that has assumptions and they're not always the right assumptions, but if we run it, it's pointing something out. So what's going on here? Why are these green? Why are all these red? Because according to the Black-Scholes model, they shouldn't be. So we see here that, look, this is the snapshot of this options chain. The stock was $39.84. $39.84. So this is kind of the closest at the money, the 40 strike. So look what I'm doing. If I'm buying this call, now I'm doing it right on the offer, because this is a wide market. Buying this call for $3.45. And I'm selling the put on the same strike for $6. All right. So I bought the call, sold the put on the 40 strike. I'm going to run this. This is a synthetic stock. This basically the delta, it should move 1 for 1 with the stock because I'm buying it on the same strike, right? So at expiration, if the stock is going, if for every dollar, it's going above 40, this call will be worth, will go out, will correlate to that. For every dollar it's going below 40, this put will correlate to that. So here's what it looks like, right? It's like a synthetic stock. It goes up, you're making money, it goes down, you're losing money. But look where the spot price is, $39.84, right? That's where we were at the snapshot. But since this put is bid up so much higher than this call, right? People want to get short. There's a demand to get short in the markets. To get short, if you're lining up more people to get short than to get long, people are starting to pay to get short. And you could see here synthetically, well, what are they paying? So just here on these prices alone here, look where your break even, 39.84. Your break even's over here somewhere, right? 37.50 around, something like that. All right. So the markets themselves are saying, hey, if you want to get long Robinhood synthetically, right? If you want to get long, I'm going to give you an extra $2 in your pocket from the spot price. So you could get long from now till December. You see that? Do you guys see that?
Let us know if you see the concept, guys, if you're grasping.
So that was and this is one way. What are the markets telling us? That for whatever reason, traders are looking at it, investors are looking at it, and that there's an enough demand to get short Robinhood and we'll see if today after the earnings, if that starts to cool down, or maybe heats up. We'll see, maybe now that rate will even go up higher. But what the markets are telling us that, so far, there are an overwhelming amount of traders enough to, push those short rates up, and people willing to get long. If you're willing to do it synthetically with the options, it's like you're getting extra, right? They're giving you extra. You got like another almost $2 and cushion. Probably you could get more because you could see these markets are pretty wide. 255, 375. I would even, here's the midpoint 315. You could probably, I would have guessed, probably get it even closer to this bid. All right. So just looking at how the demand is lining up to get short in Robinhood. So you got a pretty, or I'm sorry, closer to this offer, right? You're selling the put. Sorry, closer to the offer. You're selling the put, buying the call. So probably instead of, not 255, you get perhaps an extra dollar. So you're getting already $2.55. Probably get an extra dollar out of it if you're willing to go long synthetically. It's like buying it, right? Buying it at a lower price than the spot. Of course, yeah.
Hey, D, Jeff is just asking for confirmation that what the concept you're showing us is also referred to as skew.
So this isn't skew. This is cost of carry. Okay, so this is the different. Now skew is different. Skew is, I'm going to close it. Skew is where there's a difference, right? When we're going through different strikes, the different strikes have different implied volatilities, right? So they're not all the same. And the skew is the difference between a spread, right, between one strike and a different strike, right? And there could be a vertical skew or horizontal skew. Like a vertical skew would be within the same expiration, right? Like here, well, I could buy this call, which is a 77.6 volatility. I could sell this put, which is a 92 volatility, meaning that on a relative basis, there's more premium in this option than, in time premium than in this option. Okay, that's a vertical skew. Or horizontal skew would be something like a calendar spread where you're selling one expiration because the implied volatility might be higher or lower, and buying a different expiration because volatility is higher or lower, and you think that they're going to come closer to converge. So it's not skew, it's cost of carry. Okay, so skew would be different.
All right.
Okay. So hopefully, that cost that, that example kind of gets you thinking differently than just up or down, right? It gets you thinking like premium and discount to spot price. Okay. So premium to discount to spot price. And let me tell you, people, we've been trading on the floor for a long time, right? Well, on the American Stock Exchange, members of SIBO, people have made fortunes doing that, right? Trading spot versus derivatives, based on cost of carry.
Well, actually, Laurent was asking, does this give us an arbitrage possibility?
So, unfortunately, as a retail investor, probably not, because the only way to lock this in, let's say you buy it at, you buy this call at 345, sell this put at 60, right? And let's just say that's where you get it off. So in actuality, you're buying it at like, let's say 37.50. Okay, let's just say 30. You're buying the stock at 37.50. To create an arbitrage, you have to short it at 39.84 and wait for them to converge. By expiration, they should converge. The problem is, as a retail investor, nobody is going to let you borrow that stock, especially if you not for free, right? So first of all, you're probably not going to be able to borrow this stock, because I'm sure that the market makers and whoever's holding, stock can create this arbitrage opportunity, right? So Goldman Sachs, they're making markets in it. So they're not going to lend out their Robinhood stocks. They're like, well, I could go in there and, create my own arbitrage, right? So they could borrow from themselves. And if there's stocks, if there is stock available to borrow, you're probably going to have to pay a rate that is higher than what these markets are implying, right? Because your broker dealer sees this. They already know what's out there. They know the rates they could get. So only if you could find somebody to borrow the stock from to sell it short, maybe then you would be able to, but not as a retail investor, there wouldn't be an arbitrage. Broker dealers probably can.
Yeah, and that short stock can get called away from you as well. There's a risk of that.
Yeah, exactly. Because you're locating the stock, but it could also get called away from you, so you have that risk. But usually these arbitrage opportunities will be, it'll be market makers or broker dealers who have access to the stock alone, marketplace that is not very available to the retail, unless it's like very easy to borrow, unless you're like, doing it in something like SPY or Apple, or who nobody's shorting, or not enough. But in this case, no, you won't be able to, but the markets are telling you something, right? And there could be opportunities there if you're seeing things lining up in a way that, hey, at this point, if I want to get along Robinhood, this might be a better way to do it. Spread things off, but not a straight arb. But doesn't mean you shouldn't be aware of what's going on, or that there can't be an opportunity. It just depends what you want to do. So hopefully this was helpful. No more questions. I'll leave it at that.
No, we did have one. Trevor was asking, can you go over synthetic stock concept again? But it's 9:27. That sounds like a whole episode.
So synthetic stock is recreating. It's what you're doing is you're using the options to structure them that the options behave one for one with the stock, right? So the idea is that if your options, right, are, if you're buying the call and selling the put on the same strike, you created a synthetic stock, basically delta of the stock. So it should move, just like the stock. Like you see here, this is what the stock would look like. So that's the synthetic stock. It's a synthetic stock. And by the way, you could go and read this. I'm introducing you to the concept, but you could go look up synthetic stock, Google it. That information's out there. The Black-Scholes model, that's out there. You could go read about, cost of carry. You could go read about, reversals, conversions, all that stuff. It's out there. I'm just I'm just kind of introducing you guys to it and showing you visually an example. But that's
I'm actually the great thing about our YouTube channel is you can search, and you put out a video on synthetic long stock discounts, a whole
I did. Okay, yeah. So there's probably some videos out there I did, in previous videos you could probably go and reference as well.
Well, I just put it in the chat, so it's there.
All right. Well,
awesome job, everyone, buddy.
Thank you for joining. Stay safe out there. Have a good trading day, and we hope to see you guys tomorrow.
All right, trading.